Hi everyone, welcome back to Corporate Decoder. Today we are diving into the latest filing from BXP Inc., also known as Boston Properties, one of the largest office REITs. It's a quarterly report, so while we might not uncover any shocking surprises, the financials may tell a different story than the press releases. This report basically gives us a snapshot of how BXP is doing, what they own, what they owe, and what they see coming down the road. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below, where you can share your thoughts on the future of the company and the office REIT market. Let's start with a look at what this report actually covers. We see the usual financial statements plus management's discussion and analysis. Think of that section as the company explaining its own performance in its own words. Lots of numbers, but that's where the insights lie. First up, let's check out BXP's balance sheet. A key number here is their total real estate holdings, which are about $21 billion, or the wearing down of their properties over time. It's a slight increase since the end of the previous year. They are in the real estate business after all, and owning a lot of real estate is kind of the point. Now, on the liabilities side, we need to pay attention to what they owe. Their unsecured senior notes, which are like big loans, stand at about $9.8 billion. That's a big number, but it's down significantly from the previous year, showing that they might be deleveraging. However, something interesting is that they took on $300 million from their line of credit and now have $500 million of commercial paper. Those are short-term obligations. I wonder if the $300 million from their line of credit and now have $500 million of commercial paper. Those are short-term obligations. I wonder if the $300 million from their line of credit and now have $500 million of commercial paper. Those are short-term obligations. I wonder if the $300 million line of credit will turn into more long-term debt later on. Let's also look at the equity situation. Their common stock is valued at only about $1.6 million, but shareholders' equity is at $5.3 billion, which means that most of their equity comes from other sources, such as additional paid in capital, money from investors above the face value of the stock. They also have negative dividends in excess of earnings of $1.5 billion. This means that they have paid out more in dividends than they have earned in profit, which is interesting as it shows either that their business is in some decline or that they are overly aggressive in rewarding shareholders. Now, let's flip over to the income statement, which shows how they actually performed during the quarter. Total lease revenue is about $11 million, the lion's share of their income. And hotel revenue is just a tiny sliver at roughly $10 million a year ago, which is great. Looking at expenses, rental expenses, or the cost to maintain those properties make up the biggest expense at about $331 million. And the bottom line is net income was $86 million compared to $106 million a year ago. SA Roller, remember, it's not about raw number. It's not about raw numbers. It's about what the company did to get those numbers. We need to look at the expenses too. And as usual, a chunk of that net income does not actually reach shareholders. This time, that cut is roughly $25 million taken by non-controlling interests, which represent partner equity that is not owned by BXP Inc. Let's now see how that profit is translating into cash. Net cash flow from operations is positive at $210 million, but significantly under the $850 cash due to some investing and financing activities. This tells me that they have significantly increased investment. For example, they put $138 million into construction and also repaid a whole bunch of debt, but this did not translate to a big loss in cash and cash equivalents due to new borrowing, which is something for an investor to look out for. Looking at the debt payment schedule, we see that they've repaid a good chunk of both secured and unsecured loans, with billions changing hands. That's a lot of activity. Alright, now let's switch gears. These filings are pretty standard, but the notes to the consolidated financial statements section often holds more interesting details. First, the real estate section. There is nothing particularly insightful here. It's all pretty standard with breakdowns of property types. Then we have derivatives, basically complex side bets on interest rates. We see that the company utilizes interest rate swaps to manage interest rate risk. This is important for any real estate company. The details on these contracts in Note 7 are interesting, but a bit too technical for this video. Non-controlling interests are in the following note. Let's see if there's anything interesting there. It looks like units can be exchanged for common stock. The details about the share-based compensation are something to be aware of, but not very insightful. Jumping to stockholders' equity, it's all pretty standard and describes what kind of stock is out there. Now let's look at the segment reporting. This report splits out the revenue by major metro area. The biggest sources of share of revenue are by far office, and the main areas are Boston, New York, and San Francisco. There are some significant insights here on where the company is making the most money, and thus they can make a decision on where to focus on. The debt and risk factors are, as usual, a legal and accounting necessity, but do not have anything interesting to a standard investor. The CEO and CFO think the controls are in place. That's good to know, but not worth reading really. Alright, we've made it through the whole filing. Tegaritz. Overall, Boston Properties is a huge company and their results reflect that. While a couple of numbers that we noticed are interesting, they are probably in line with the larger volatility of the market, for example, interest. The company seems stable and has a strong leadership position. Withstanding a market-wide event, Boston Properties is unlikely to give any crazy news in the future due to the inherent nature of the slow-moving real estate market, which might be good for some investors and bad for others. What's your take on these numbers? Let me know down in the comments and be sure to like and subscribe for more corporate deep dives. Also, don't forget to join our Discord community linked in the description, and thanks for watching.